Hey there, welcome to today's episode of Moving Markets Podcast. My name is Jeffrey Dunyan. I am the founder and CEO of Safe Option Strategies. I'm going to take the next few minutes, as I always do, and recap what went on in today's market, try and give you some insight into why things moved the way they did, and to see if I can give you a little guidance on what to expect later in the week and especially for tomorrow's market. Make sure at the end of this presentation, at the end of this podcast, that you follow us or like us or subscribe to our YouTube channel. You're going to get content like this every day that the market is open. And from time to time, we'll tell you about ways you can become a full member of Safe Option Strategies if you're interested in following us in the actual trades that we send out to our members. Enjoy the presentation. So we had a down day on the market today. These are futures that I'm looking at right now. Let's go back to what the markets actually did. Not too bad. Whoops, I messed up my screen share. Give me just a moment. There we go. Not too bad on the S&P. A little over 1/3%. NASDAQ not even 0.2% down, but the Dow about 2/3% down. Now, the good news for today's trading is that the Dow was down over 300 points at one time and actually rallied back towards the end of the day. If you look at the intraday chart for what the Dow did today, you can see that at its deepest point before the markets closed, it was down quite a bit farther. And then in the last, I would say about 2 hours, hour and a half of the market, it rallied back a fair distance, not up to as high as it was as its best point of the day, but still it rallied back a little way. What was the reason the market sold off today more than anything else? I think two things. Number one, if you look at the Dow Jones Industrial Average and what it did today, probably, let's go back to today instead of pre-market for tomorrow. Give me just a second here. One thing you gotta, I'll tell you why this is important. Almost half of this, maybe a full half of this, was Boeing. And when you recognize that a good portion of this movement down on the Dow was one stock, all of a sudden this doesn't look so bad. This doesn't seem like it's as big a deal as what it is. 231 is not a massive, crazy overselling day. But it's still, it's a little bit of a sting based on some of the good days the Dow has had, based on some of the recent highs that the Dow Jones has hit. Yeah, 231 is a pretty good sell-off, but keep it in context. When half or more of that is in one stock, that means that the Dow really didn't suffer all that much today and was maybe right around the S&P and the NASDAQ between 0.2 and 0.3% to the downside overall if you discounted that one stock. A couple of things affected the overall market, all three indexes today. One of the things that affected it is there is some growing concern over supply chain issues and specifically the situation going on in the Middle East and in the Strait of Hormuz and the Red Sea and the Persian Gulf. There's starting to be some impact. The Houthis continue to fire missiles at ships, even though they've been bombed a couple of times by the U.S., and it looks like that may continue. That is starting to weigh on people's mind as far as supply chains go. And people are starting to get a little bit concerned that could have a bigger disrupting effect than what we have seen so far. So far, in this Middle East conflict that is going on since the first part of October, when Palestinians attacked Israel and committed a horrific terrorist act against Israel, since that time, the market has largely ignored the conflict. You go back and look at a chart, that situation took place on October 7th. And all you had were a couple of days that the market was down, and then we had this rally that I'm still scratching my head over. Oh, I'm sorry, and I'm sorry, I put the wrong spot on there. Here's where it happened. Back here on October 7th, and we had the Dow Jones go up a little bit, Little bit of sell-off when Israel struck back and it looked like things were going to get a little scary there, and then the market has largely shrugged it off and blown it off. There might be some concern and some fear creeping back in just a little bit, and we'll see how that plays out in the next couple of days. The other thing that probably tumbled things a little bit today was this Empire State Manufacturing report. A lot of times this report does not get the kind of play that maybe it deserves. It's looking at one single state. It's trying to look at that state through the prism of, is this a large enough? And New York's a heavily populated state, second heaviest populated state in the country, I believe. Is that a big enough sampling of what is probably going to happen or could happen potentially in the rest of the United States? But keep in mind, this is a rear-looking report. This is numbers that have actually already taken place. Some people shrug this off a little bit because they say this information is in the past and we only have a way to go up from here. The only time this number has ever been this low then was in the early days of the pandemic. And this should be a little bit of pause for concern. If you've been with us for a little while, even as little as 4 or 5 months, you know that I said multiple times last year that I thought the direction and trajectory and the amount that the markets were moving were somewhat divorced from the economic conditions in the country. There may be a little bit of a reckoning starting to take place. This is the type of data I'm referring to when I say that the economic fundamentals, that what consumers are feeling, what consumers are experiencing, what the average person, the average non-politician, non-wealthy person in America is feeling day in and day out is very different than what's happening in the market. This is where there may be a little bit of a correlation between these kind of numbers and the actual reaction of the market. Now, it wasn't a huge day down. It wasn't a massive sell-off. There's housing data coming out the rest of this week, and you gotta kind of pick your battles and decide where you want to be positioned as the week goes on. One thing that I will tell you, I'm hearing this pretty consistently from a number of analysts that I think are pretty sharp and have their act together and don't try and sugarcoat things. Now is not the best time to throw your money into an index and simply play the market. I'm not saying you shouldn't do that. I'm saying it's not the best timing to do that. Maybe you wait for the next pullback. Maybe you wait for a level of support to be tested. And if you get a little bit of a bounce, you buy that dip and you play into one of the indexes, whether it's the Dow, the NASDAQ, the S&P, the Russell. But right now, when you're sitting here and possibly making a little bit of a turn, it's not the best time to play the indexes. We could get wobble like this for a month or two. Now is what a lot of people refer to as a stock pickers market. You look at companies that are likely, or at least that your due diligence and your homework tell you are more likely to beat the market. I suspect over the next quarter, we're going to get a lot of back and forth, maybe a couple of small dips and slight rebounds, but I don't think when we get to the end of first quarter, I'm going to be a little bit surprised if we're trading higher than where we've started the year here in this area right here. That's with the Dow, that's with the NASDAQ, with the S&P. It could happen. Anything could happen. I'm going to be surprised if it does. I think what's more likely for this first quarter is that we're going to get a lot of mixed earnings numbers. You're going to continue to get this wobble with maybe a little bit of a slant to the downside. I don't think it's going to be real ugly right now. I don't think we're going to have some massive sell-off in the first quarter or some major market correction, but I think you're going to have something in the first quarter that looks kind of like this. That's not a huge, massive sell-off. That's probably barely, I'm not even sure if that's a full 10% correction, but it's probably close to it. I think after this kind of a run up, a correction of that sort is probably needed and probably appropriate. I think it'll be somewhat slow moving like this. This took place over almost 3 months, and I think we're probably at the precipice of something like that happening again. And that means, and that's part of why I say it's not the best time to stick money into a general index fund like the diamonds, the Qs, the spiders. There will be a time where those are good plays. That right now is not them. I think right now is when you look at companies that more often than not tend to buck against a gradual trend like that. Companies that I'm putting my money into include Walmart. I would also look at Costco in that retail space. In spite of the fact that we might do this, a couple of the chip makers that are on unbelievable tears, and I think they will continue to push past and defy what the market does, will be NVIDIA, AMD, and looks like I'm trying to write in some goth way. AMD and Micron. These are companies that I would tend to have money in right now in the because I think these are three of the companies that I think are best poised to continue strong and continue to grow in the face of some of the other challenges that the market might have. Now, supply chain issues could affect these, so I would be cautious with these ones right here. They could affect these two as well, but these are pretty resilient companies when it comes. There's some of the few companies that I think have the ability to buck the trend of the rest of the market. I would also keep a really close eye. It's been beat up a little bit recently, but I would keep a really close eye on Amazon and consider some money on Amazon. And that's kind of a hybrid between your retail and your tech and your AI companies. And I believe one of the leaders in AI is going to be Microsoft. And Microsoft today hit an all-time high. I don't think they finished at it, but they hit an all-time high. And they actually overtook Apple in market cap and basically being the highest valued company in the world and in existence, at least for a brief time today. These are two other companies that I would be willing to have money in. If you will make sure that you tune in to what we put out on Friday after the market closes, I'm going to give you a little bit lengthier watch list with a few more companies besides these one. A couple of my dark horse picks for this year, companies that I think I would be invested on throughout the year and take every advantage to buy on any dips that they might have. So that's basically where we're at. That's kind of a recap of what took place today, a little bit of what to look forward to in the rest of this week. And we appreciate you joining us. If you are new to Safe Option Strategies, if you're not a paid member of the program, you are welcome to subscribe to our YouTube channel. You're welcome to follow us or like us. And you'll get these market recaps every single day and get our thoughts on what's going on every single day. And from time to time, we'll tell you about what you can do to become a member of the program. The one major benefit that members of our program get is the trades that we send out every week and the education on how those trades work. Last year, we produced a return on those trades of a little over 104% in 2023, and we were close to that. Missed it by maybe just 1% or 2% for 2022. That's the advantage to being an actual member of Safe Option Strategies. But you're welcome to come on and view every day that the markets are open, our market recap. Make sure you follow us or like us or subscribe on YouTube or wherever it is you're seeing this. And hope everybody has a great rest of your day and hope you have success in your trading. Thanks. Bye-bye.